So next up, more digital assets, but specifically digital asset tailwinds. So welcome, Matthew and Merle. More than 30 years ago, we digitized public equities, and today they're traded close to 24/7 with enormous liquidity in global marketplaces. Conversely, in 2021, more than half the world's assets are still paper-based, including most real estate funds and private investments. So over to you, Matthew. You're going to discuss all the tailwinds that make the digitalization of all assets an inevitability.
Thanks a lot, Irene, and it's great to be here as always. Before I get started, I want to mention something which hopefully Bill won't be too annoyed with me mentioning, but that is there's this most amazing get $1,000 of XRP when you invest something on Link2 going on. But I think I found a bug, which is if you minimize your investment down to 10K and you do it twice, you actually get 2 lots of 1,000 XRP, which is what I just did. So I'm not sure that they intended for that to be true, that you can do lots of 10K investments, but
yes, we did intend that to be true.
Okay, well, it's you know, obviously,
yeah, we meant it to be per investment, and we hope that a lot of we're trying to get all of our members into the habit of diversification. So that's a part of it too. We'd rather they go and buy a number of different things with a lower volume. So that's part of the incentive.
So I can't believe how generous you're being, and I want to go to Portugal too. But anyhow, so the purpose of this really is to share some thoughts. I'm going to do this as a presentation. In a way, for all of you listening, these are some of the rationales for why everything that you're spending all of your time on is powerful and inevitable. And with the holidays coming, you're probably going to have to explain yourself to all sorts of family members and the like, friends and so on that you'll meet. And in the next few minutes, I'm just going to go through the major theses behind why digital monies and digital assets are now inevitable. We are blockchain co-investors. We are actually on the Link2 platform. We're the world's leading blockchain fund of funds, investors in 30 blockchain VCs in North America, Europe, and Asia. We are very excited to be able to say we are an investor and have capital in half of the 62 blockchain unicorns and about 40% of the crypto projects in the early stage. And that's what we do. Our performance has been nothing short of remarkable. We are, according to Preqin and PitchBook, the highest performing fund of fund in the world in our category. And all of that's on the Link2 website. These are some of our VCs. And so if you just go to Link2, you'll find us probably at the bottom of the screen, blockchain co-investors, and you can just click on us and become an investor and join us as many, many other Link2 members have done. Now, having said, and we have the world's largest and best funded blockchain SPAC, collaborating and partnering with Cohen, Cantor Fitzgerald, and Merle. I'm not going to talk about that today. So these are basically 10 different arguments for why digital monies and digital assets are going to be an inevitable part of our futures. And these are not my arguments. I thought that it would be more interesting for you if I synthesized the arguments of some of the world's greatest investors and just show them really, really quickly. So I'm going to do 1 page per theme. So this is the first. This is Paul Tudor-Jones, one of the world's greatest hedge fund managers. And he talks about the great monetary inflation. The thesis here is pretty simple. We thought money was scarce. Our governments have proven to us that it isn't, that they can print as much as they want, and they've been printing like crazy. And if you print a lot of money, you by definition alter the supply, demand, and price dynamics. It should go down in absolute value. Meanwhile, scarce assets like gold and Bitcoin should go up. And his thesis is simply that there is an arbitrage opportunity between the non-scarce assets of the world and the scarce assets of the world, and he calls that the great monetary inflation. The second argument is the Bill Miller argument, again, one of the world's greatest hedge fund managers. He is simply looking at the arbitrage between digital gold and gold. And his argument is that gold is important. Gold has a lot of features that over the last few centuries have made it attractive to many, many investors. And globally, it has a high penetration rate, which is to say many, many people, organizations, institutions have a little bit of gold. Bitcoin has some superior characteristics to gold in terms of its ease and ability to move, its scarcity, in fact, and some other characteristics that come from being a digital asset. And so this is simply an arbitrage story. There's Bitcoin's returns on the left, gold's on the right. As the penetration rate of Bitcoin increases, the relative arbitrage is in favor of Bitcoin. And by the way, the penetration of Bitcoin is really, really low still. There's 8 billion people, there's hundreds of trillions of dollars of capital, and relatively little of that is today being exposed to Bitcoin. Very few institutions, very few people, and not that much capital has found Bitcoin yet. The third argument is a more fundamental argument about exponential technologies. And this is sort of where we come in, Alice and I being internet and fintech investors for the last 20 years and more. This is Cathie Wood's, probably the highest returning ETF manager in America, if not in the world. And her thesis is pretty straightforward. It is that technology is the future. And if you back technology initiatives, exponential technology, as they roll out, it doesn't all have to be around digitization of financial services, monies and assets. It could be life sciences, it could be clean energy, but you're on the right side of that curve. And many of you have heard us talk about that too. You can't miss the reality that in our lifetimes, over the last 20 years, most of the most valuable companies in the world are today internet companies. And that is part of the phenomena. But Cathie Woods would argue there's a lot more coming. So that's, and this is her ARK fintech ETF, which has pulled ahead of many others. Now, digital monies and digital assets actually do play a major part of this exponential technology thesis because they are horizontal. So whereas life sciences is sort of a vertical, the internet and digital monies and assets are a horizontal because every business, every government, and every individual is involved in one way or another with commerce. The next investment thesis is this one from Fidelity. It's a pretty straightforward thesis. It's that in an optimum portfolio, you need to have multiple types of assets represented, and that alternative assets need to be in the optimum portfolio because they have an impact on the risk return and diversification characteristics of the optimum portfolio. And Fidelity points out, as you know, others have pointed out for decades, that most traditional alternative investments like hedge funds may well be permutations and combinations of public equities, fixed income, and real estate, which are not really viewed as being alternative investments, they're core investments. So a true alternative investment needs to be something more than an alternative vehicle permuting the core asset classes. And that's where Bitcoin and blockchain and digital monies and assets come in. They bring the prospect of expanding the optimum portfolio and the horizon and returns associated with it. The next argument's from the CFA. So this is the organization that represents America's financial advisors, wealth advisors, RIAs, and so on. And their argument is pretty simple. Clients want it. And that is today an unmet need. Many clients around the world want more of the digital assets, the crypto assets, and digital monies that we've been creating, and many of them don't have access. So the argument here is that there is a unserved wall of user demand that's building up, and that as we have more products and more access approaches, there will be more capital flowing into the space. I'm now going to talk very briefly about Michael Saylor. He clearly has a very specific view but it is that corporate treasuries and balance sheets should include some exposure to digital assets. And it's a hard argument to argue with. I mean, the theoretical role of a corporate treasurer is to have enough capital on hand to cover the needs of the business in the up and down cycles that businesses get confronted by. But to the extent to which you have a base load of capital in the business that you don't need to touch, call it excess capital, then you need to either maximize the return of that excess capital or you should give it back to your shareholders. And Michael Saylor's point is quite simply that the returns on Bitcoin are probably higher than the returns of the core business and the other ways that corporations invest capital. Therefore, the organization, the business has no right not to invest in Bitcoin unless they're just going to give the cash back to their shareholders and let their shareholders do the same. These are the corporate treasuries. They're all growing fast. We tend to talk a lot about MicroStrategy and Tesla, but when you start double clicking, there are a lot of very large Bitcoin corporate treasuries today, and the number's growing every day. The next thesis is actually the government thesis. So the governments and central banks, just like JP said an hour or so ago, he said, you know, there were moves afoot to try and kill everything we're doing in the world of digital monies and assets. Those movements are probably now running the end of their course. I think it's true that most governments and most government officials know that digital monies and assets are now coming. The question is, do they want them to be distributed and decentralized, or do they want them to be centralized and driven by governments and central banks? That's really the only discussion, which is a big discussion for the creators of digital monies and assets, but for all the infrastructure, we're hedged. I mean, if you back a digital wallet or a digital exchange, it doesn't matter whether it's going to be a central bank digital currency or a distributed stable coin, it's still got to go through the same infrastructure. This is all driven by China. Let's be very clear about that. China is miles ahead at this point, and the other parts of the world are having to move now. They don't really have a choice. So this is inevitable. China is not going to take its foot off the pedal in terms of the Chinese digital yuan. And then there's this side of the coin, which is bankers are beginning to appreciate that the world and the world's users, like all of us, are not happy that when we send $100, the bank takes $25 or $30 of our $100 for an international transfer. That has to stop. And just to give you another example, every one of you, your principal assets, if you're a typical American, is your home. If you try and buy and sell your home, you're going to lose 6 or 8% of the value of your property just in transaction costs. And that is outrageous, and that has to stop too. And I think that the user-focused regulators and lawmakers are beginning to understand that. Digital monies and assets create more efficient ways for us to transact. I'm going to very briefly mention 3 others, and then I'm done. This is the view around assets at this point. These are examples from the big consulting firm Carney and Bain and Company. But the central thesis here is that we only have digitized half of the world's assets so far. And more than half the world's assets are still paper-based. They haven't even gone through version 1 of digitalization. And so when we think about real estate, we think about private investments and funds, most of those are paper-based assets. And there's no one in their right mind that today that says we're not going to digitalize those paper-based assets. Again, it's a question of who gets to digitalize them, and are they on, if you will, semi-national exchanges like the London Stock Exchange or the Swiss Stock Exchange, or are they going to go onto decentralized distributed exchanges? But there's no question this is now happening. And I won't talk through that, and I won't talk through that. So I'll just now finish up by talking about DeFi and NFTs. DeFi is not a new thought. Peer-to-peer is not a new thought. Historically, way back when, everything was peer-to-peer. We didn't have centralized intermediaries hundreds of years ago. We created those, and they have had a good purpose for many, many years. if we can use technology to be more efficient, more effective, faster in the management of a transaction of some description, why would that be a bad thing? And it's one of these obvious points that some things in the world today are beginning to come to the end of their usefulness. One of them is physical intermediaries, when we can do a transaction digitally. That would be an example. A second is the notion of double entry bookkeeping, when we can do triple entry bookkeeping. And the third entry is to the blockchain that everyone can see and be able to interrogate in real time when a transaction occurs. So some ways that we've done business today are beginning to come to the end of their life cycles. And we think that intermediaries and financial services are certainly threatened, and peer-to-peer is a superior proposition, even if it needs to be debugged. And by the time we get to NFTs, don't worry about the word NFT. I know we've used it non-stop today. Just think about the same point that we've talked about before. It makes no sense that your car comes with a pink slip, which is a piece of paper that you're supposed to hang on to and sign when you want to buy or sell your car. Your car will have a digitalized ownership record. And it makes no sense that you have a paper-based passport. Eventually, you will have a digital passport. So individuals and assets like cars will have digital certificates of ownership, just as public equities have today. Well, just keep going down that path. Any asset can have a digital tokenized ownership record, which opens up the prospect of greater liquidity, greater price discovery, and of course, efficient secondary markets on a global scale. And that's really what NFTs are about. So I think I've wrapped up, Kareem. I know I went quite a long ways there, but why did we do this segment? We did it because we want all of you to be armed with the principal arguments as you go out as evangelists, ambassadors, and you speak to people that maybe haven't come on board yet. And be clear, you are all pioneers. Everyone on this call is a pioneer, but there's several 100 million other investors around the world who haven't even taken the first step. And if you can be advocates, if you can be ambassadors, Lisbon is going to be full of people, and it will be very exciting. And let me say it again, we are Blockchain Co-Investors. The world's best fund of fund is available on Link2, and all you have to do is click on it, and Bill and Joe and their team will get you to be participants in our fund of funds. And with that, I am going to take this off. I think I probably burned up my time, Irene and Kareem, but conversely.
You know, you're almost there, but we're not going to let you off the hook. Thank you so much again for that wonderful presentation. Your presentations and thoughts and conversations that we've had you in the past have always been thoughtful, very insightful, and we always learn a lot. So thank you for that. We much appreciate it. Thank you very much. But let's look, we've got a couple of more minutes, and I want us to have your prediction, the most seismic change that you'll see happen, that you think is going to happen in 2022.
Yes, so I'm going to answer that with the adoption curve argument, which is a very simple thing. I already mentioned it. It's very simple. We are now entering the steepest part of the value creation inflection curve on digital monies and digital assets. Everything that's just gone on for 10 years has been laying the track. It was about pioneers, innovators, and early adopters. And that is only about 10% at most of the global interest that is now coming. The late adopters and the laggards have still to come on board, and they have the bulk of the capital. Actually, funnily enough, they have the bulk of the capital. So I think in 2022, we're going to see the steepening of the value creation curve. And the evidence for this was at the beginning of this year, we could only find about 25 blockchain unicorns. At the middle of the year, it was up to about 30. We just ran it again, and we have 62, as well as 133 crypto projects worth $1 billion or more as of December the 1st. So that is part of this adoption curve on value. And the inflection curve, the inflection point is now upon us. So I couldn't say anything more than I think now is the perfect time to be an investor in digital assets, digital monies, and all of the infrastructure that's required to support them. And I think we're going to see the valuations and the value capture go through the roof in 2022.
Thank you. You heard it here. Matthew and Merle, thank you so much.